Good morning, good afternoon, and good evening, everybody. A very warm welcome to today's Geneva Association webinar on the value of insurers and insurance in a changing risk landscape. My name is Kai-Uwe Schanz. I'm the Deputy Managing Director and Head of Research and Foresight at the Geneva Association. Today, we will focus on three areas. Number one, we will explore the shifts to the global risk landscape. Number two, we will discuss the implications for insurers, especially as risk takers. And number three, we will explore potential responses from the insurance industry to these challenges. It now gives me great pleasure to introduce our preeminent panel of speakers today, starting with Martin Ehling. Martin is a professor of insurance management and the Dean of the School of Finance at the University of St. Gallen here in Switzerland. Jane Plunkett is the Group Chief Risk Officer at AIA, based in Hong Kong. And prior to joining AIA, Jane had a long stint at Swiss Re, and her last position at Swiss Re was Regional President Asia. Thomas Seidel is Head of Group Strategy and Portfolio Management at Allianz, based in Munich. And before Thomas joined Allianz, he was a senior sell-side researcher at Sanford Bernstein and also gained experience in strategy consulting at the Boston Consulting Group and McKinsey. Last not least, Carla Smith. Carla is an Executive Vice President at Intact Financial Corporation based in Toronto. Carla wears three hats. Number one, she is the Chief Human Resources Officer at her company. Number two, she is responsible for the strategy process, for the strategy function. And number three, she looks after the prioritization of climate change from a business perspective. Now, the next slide gives you an overview of what you can expect over the next 75 minutes or so. After the usual housekeeping announcements, I would like to provide you with a brief overview of the key messages of our most recent Geneva Association report on the value of insurance in a changing risk landscape. So this report will underlie today's webinar. We will also have a dedicated Q&A window towards the end of this session. 10 to 15 minutes is our target. Now, the next slide summarizes the key housekeeping information. Please note that the session will be recorded and every participant will receive the recording after this webinar. You will have the opportunity to ask questions. Please do so by clicking the Q&A button and writing your question during the webinar. It would also help me if you could let me know to whom specifically your question is addressed. Now that leads me to the key messages of the research paper. Of course, what I will do here is just scratch the surface, but ideally it should be an appetizer for you to take a closer look, to download the paper and take a closer look at its specific findings. Now we start on the next slide with a high-level perspective on the changing risk landscape from the point of view of the insurance industry. The paper focuses on two major shifts in the risk landscape. Number one, an increased prevalence of systemic risk. So this is the vertical axis. I think we have all understood what this means. When we were locked down, when entire economies shut down, when all of a sudden millions, if not billions of people were affected at the same time and for an extended period of time. I think this is the most intuitive and plausible definition of systemic risk. The other dimension on the horizontal axis is intangibility. In line with the rise of the digital economy, more risks and more assets come in the shape of data or intellectual property and reputation. And our industry, which is still very much in the bricks and mortar world, faces challenges in that respect. And that leads me to the next slide. Insurability is really being challenged. If we can move to the next slide, please. by the factors which I have described. What you see here is selection of emerging risks assessed based on the key criteria for insurability. Take cyber attacks on critical infrastructure as an example. These risks are neither random nor independent, and as such defy two key criteria of insurability. At the same time, the maximum loss amounts go beyond the risk-bearing capacity of the insurance industry. So these are examples of the challenges that some of these new risks present to insurability. And basically all the red triangles that you see here on this slide indicate potential or de facto showstoppers to insurability. Now, how can we react as an insurance industry to these challenges? On the next slide, you see one potential answer. And all these answers have the ultimate objective of maintaining the insurance industry's relevance for society. That's the overall objective. Now, one answer might be to provide additional risk services. You see the full spectrum here. Many of these services have been well established in the marketplace for quite some time, but the shift to risk services has gained traction recently, not least because of digital technologies and the almost endless opportunities offered by those technologies, but also in response to changing and evolving customer expectations. The second response on the next slide is to promote sustainable insurance and investment propositions along the insurance value chain. Starting with product design, you can think of products which incentivize risk prevention. On the underwriting side, you could think of approaches which prioritize impact or inclusivity, for example. In the claims field, think of services which help customers build back better after major disasters. And last but not least, asset management, of course, a huge lever for an industry with more than 40 trillion of assets under management. You see some examples here. Let me single out the funding of green technologies, because this is currently a major research focus for the Geneva Association. And you can expect 2 research papers early next year on the role of insurance in promoting, in accelerating the commercialization of such climate technologies. Now, moving to the next slide, and the third potential response, public-private partnerships. Of course, those PPPs have been in place for many years, but mainly focusing on natural disasters or terrorism risk. Now, as I said before, we have to find answers to bigger risks, to more complex risks, to more interconnected risks. And we may see more PPPs with, for example, high or uncapped government backstops, and PPPs that need to be designed in a way that insurers can play a role also in the management of these major systemic risks. So the final slide, if you are not yet convinced whether to download the paper or not, maybe this is the ultimate nudge, hopefully. We have commissioned a customer survey spanning the 6 largest insurance markets in the world in order to test our hypotheses. And here you see a number of key findings summarized. The first one clearly shows that insurability is a real concern for customers. It is not an academic debate. This is not a debate in certain circles of insurance companies. It is real. The second key finding is that the vast majority of customers would like insurers to collaborate more closely with governments to address some of these insurability issues. The third finding is a very encouraging one, because as we found out, the interest in additional risk services is significantly higher than the actual usage of such risk services. So this indicates a robust appetite for services that go beyond beyond claims payments. And last not least, this came as a surprise, frankly, the awareness of sustainable insurance and investment propositions is still relatively low compared with the awareness of other risk services. So that might be a call for action, a call to action for the insurance industry. So let me stop here and now, without any further ado, open the interactive part. And I would like to kick this off with a few questions on the big picture, the risk landscape as it has evolved around us. And maybe starting with Martin and your global and research perspective, when you look back to the last 5 or 10 years, what in your view are the key changes to the risk landscape? And equally interesting, which changes would you expect to stick?
Well, thanks at first for having me here on this nice panel. So if we look over the past 5 to 10 years, certainly there have been a number of very significant changes on various fronts. First, maybe when we look at technology, just recall that ChatGPT is only 1 year now, and how much that has changed our view on artificial intelligence. So the technology perspective certainly is one. The rapid advancement of AI and automation, which has not only reshaped a number of industries, but also the nature of our work. Then, secondly, certainly the geopolitical shifts in power dynamics and the rise of new economic players that we have seen, especially in the last 2 or 3 years, which also introduced some uncertainties. Certainly also climate must be on the list. So the increasing frequency and severity of extreme weather events worldwide. And finally, as you already mentioned, we have the COVID-19, which has shown how interconnected our health, but also our economic systems are in a way that nobody could ever imagine. And now when we assess a little among those 4, the persistency, I would say that without doubt, the technology advantage and their societal implications are likely to endure. Geopolitical shifts also may persist, however, they at least can be influenced to some extent by diplomatic efforts, international collaboration. Also, climate-related risks are very likely, unfortunately, very likely to persist and even escalate, given the climate change requiring a lot of attention and adaptation. And finally, the pandemic has, as I mentioned, fundamentally reshaped our understanding on global health risk, emphasizing the importance also of preparedness and collaboration.
Very much, Martin. Turning to Jane as the Chief Risk Officer of a major life and health insurer in Asia, could you elaborate a bit more on the dynamics of these risks? So, for example, in what areas do you see risks accelerating or changing nature or shape?
Thank you, Kai, and I want to thank the Geneva Association for having me here, and congratulations on this report. I guess maybe I would start, Kai, with just the fact that these risks are so interconnected. It sounds like it's something simple to say, we all know that, but both on the asset and liability side of the balance sheet, they're very interconnected. And I think this is probably the number one thing we have to recognize, is that this interconnectedness will increase, not decrease, over the next years. And so how can we better deal with that? I think we're doing a better job of recognizing that, understanding it, quantifying it. But it means that, our risk models have to take these relationships into account. And we have to consider the knock-on effects of first order risks. It's very easy to see a first order risk and think it's not affecting me, but I have to think through to the second order effects of all those things that are happening. And so I think that's something it's slightly new. I think the other thing to highlight here is the computational power is also increasing. So there's no doubt in my mind that our risk modeling can keep up with this changing landscape and all of this information. I wanted to add just 2 more things. So first of all, I thought the customer metrics at the back of the report were really interesting. And of course, they come from all different jurisdictions, all different markets. So you expect to have these differences. But I was really left wondering about the difference between perception and reality with some of the responses, because it's very easy to say, yes, but we do that, but obviously sometimes our message as insurers is not getting through. And so I was really left, thinking, how can we be more effective when I looked at those metrics on the customer side? And so maybe finally that leads me to one risk driver that I certainly see accelerating. And I think Martin pointed to this when he talked about technology, but I would put a different spin on it and say it's something about the volume and the velocity of information and how it's being shared among different groups of people. And this, affects all kinds of things. It affects different outcomes. We've seen examples of how people are quickly able to connect and share information, maybe for good outcomes, but also for bad outcomes. And so I think it's something we have to be really cognizant of, is that the volume of information that's available to consumers, but also to us as companies, is increasing exponentially. And the question is, what do we do with all of that?
Thank you very much, Jane. Carla, as I mentioned in my introduction, you are also running the human resources function at Tech Financial Corporation. So from your people perspective, which particular risk would you like to emphasize or maybe even add to the discussion?
Thank you, Kai, and great comments by the panel so far. Pleasure to be here with you. So yeah, in the P&C industry, I'll start by saying that I think when people think about evolving risk, we're most likely focused on the weather, as has come up already. And I'd start by saying, with my Chief Climate Officer hat on, that definitely should continue to be a key area of focus. That said, you're very right to point out that there is a broad and changing risk envelope beyond those that are climate linked. And when I think about the implications from a people perspective, a few things definitely come to mind. So first, there's the fact that the evolving risk envelope by default means an evolving technical skill set in the teams who are underwriting, pricing, settling claims, assessing those risks. So if we want to be successful as firms, we'll need to be proactive in finding ways to develop our people's expertise and our operating models in those areas. The second thing that comes to mind is that our people will very likely be performing in an operating environment where the processes, the technology, the tools that they're using will be very different than today. So we know that digital interactions have already changed the employee environment over the past decade, and the pace of this change is likely to accelerate with the emergence of things like generative AI. So we'll need to support them in adjusting to that new operating environment. And finally, post-pandemic, most of us are now working in a hybrid setting of some sort, and even this panel is a good example of operating in a bit of a hybrid environment. And I'm not sure that all industries or even all employees have yet successfully navigated that transition. And so, for example, in our own case, we've noted that the onboarding experience of new employees certainly is not as rich when we try to execute it virtually, despite many attempts. And so this can impact the speed at which they learn new skills, build expertise, even feel a sense of belonging, which subsequently impacts the organization's ability to adapt to change. And also, in a world where mental health and inclusion are an increasing focus, it's really important for all of us to consider the unique needs of certain employee groups when designing and executing those hybrid working models. So that's where I'll leave it, Kai.
Thank you very much, Carla. You mentioned mental health, and I'd like to point all of you to a Geneva Association research paper, which we put out earlier this year, which met with a significant degree of interest. And this is really also something where the insurance industry, I think, needs to think harder as to its own relevance to addressing those challenges. Now, finally, maybe Thomas, we heard the academic perspective, we heard the life and health perspective, we heard Carla's P&C-based people perspective. You represent a company which is a leader in non-life and life, but also in asset management. Is there anything? Are there nuances which you would like to add to the risk picture painted so far?
Yeah, for sure. Thanks for having me, Kai. I think the first one I would like to single out is longevity risk. I think it's also coming out strongly in your customer survey, right? And I think we may have become a bit complacent there because we have taken a pause on longevity, but in my mind, it's not unrealistic to think about significant further longevity increases over the next decades. And that, of course, is a systemic risk we all need to have on our radar. And it's also relevant because we are back to 1986 penetration levels when it comes to life insurance, right? So life insurance is basically a sector which is lagging a lot in terms of delivering on this longevity opportunity. And I think we need to do a lot better there. That's the first one. Second one, of course, yeah, technology risk. I have to mention again, I mean, just the sheer number, right? There's 1 trillion of economic losses from cyber every year, and we cover less than 1% of this. For sure, there's risks which are difficult to cover, but I'm also sure we can do a lot better than this 1%, right? So I think also in line with what Jane was saying, right, there's a lot of connectivity coming up, connected devices set to grow from 15 to 30 billion over the next years, right? But this risk is going to expand, and there's a real demand. And also when you look at your own report, right, you showed how the balance sheet of corporation is changing and the physical assets get ever less relevant, intangible assets gets ever more important. So in order to stay relevant for our customers, right, I think this is very important that we get our head around this difficult risk. And last but not least, just as a question, maybe I wonder what the next asbestos is, to be honest. We didn't talk about retrospective liability. I mean, here we talk about ex ante uncertainty, but as we know, there's also a lot ex post uncertainty in the liability space. And for example, recently I saw climate suits growing a lot. I'm not sure if this is the next wave or what it is, but I'm pretty sure that is also a risk we need to have on our radar. I mean, asbestos was one of the biggest payouts ever, I think, in the insurance history.
Thank you very much, Thomas. This is a nice transition to the next question. So what for our industry? What are the implications, especially for our traditional role as risk takers? And if I may start with Jane. Well, Thomas mentioned longevity, but most of the risks we discussed so far, and also the paper discusses, have a certain P&C bias, property and casualty bias. So, what do you think as a CRO of a major life and health insurer? What's the relevance of the insurability debate for you, for your company, and maybe also for Asia? Is there a difference between the discussions in Asia and other parts of the world?
Yeah, it's probably a bit different, but I don't know. The other panelists can correct me. So if I just look at AIA, our purpose is to help people live healthier, longer, better lives across 18 markets in Asia Pacific. So we're very focused just on this region, which might change my comments versus others. But continued insurability is obviously really important to us because that's what makes our company tick. And I think when I look at the area of insurability, I look at those 9 criteria in the paper and how we assess insurability. And in my view, I think we'll see increasing insurability on the life and health side, not decreasing. And the reason I say that is because I think we're understanding those 9 criteria better and better every day. So it means we should be able to bring more of that risk into our umbrella, so to speak, and protect it. And there's no better place than these markets, because we can see that we have certain structural drivers that are fueling that need, from rising levels of private savings to a growing middle class to aging populations to low levels of insurance penetration. We have this sort of perfect combination of criteria here that tells you we need to increase the insurability, not decrease it. And if I just think about the sort of post-COVID, we did a small survey for ourselves, and we know that something like 64% of our customers that are surveyed are more concerned about personal health and protection after COVID than they were before. So their demand is also increasing. And I think maybe the last thing I would put is that we know that the protection gap across Asia Pacific in particular is growing as fast as the markets are growing. So even though the companies are growing, so is the need. And that protection gap will be something, on the order of $1 trillion by 2025. So I do hope that we can broaden the insurability across certainly the life and health risks that we see in Asia, because I think there's a demand for it. And I also think, that's how we help people to protect their assets, is that we make those things more insurable, not less.
Thank you, Jane. I was just struck by the protection gap you mentioned. I think I'm very passionate about it. Few people know that the health protection gap is a multiple of the net cat protection gap. Net cat protection gap is highly tangible. It gets all the attention. But the health protection gap in numbers is 4 times or even 5 times net cat protection gap. And it can throw as many people back into poverty as uninsured natural disasters. So just a bracket close. Thomas, I think the question for you has already been a bit introduced by Jane. The insurance industry has been facing insurability challenges throughout its history. It's nothing really new. And over its history, the insurance industry has always been able to come up with answers or responses, which at least partially helped mitigate those challenges. Now, from today's perspective, what would you consider the most promising risk transfer innovations that could help us maintain our relevance in light of these challenges from today's perspective?
First of all, let me reiterate what Jane said, saying we are also a bit more positive on the insurability side, right? So we feel, with few exceptions, for example, on the weather front, we can be doing well. So that's to start with. And then I'm not sure it's about risk transfer per se, to be honest, Kai. It's more about what you do before and what you do after the events, right? And first of all, I would say, even though we have improved insurability over time, I think we can still speed up and provide more innovation. I think the speed of change is getting up. For example, the secondary perils in NatCat, my sense is that we have been a bit slow as an industry to get our head around. So I think after 2-3 years of wildfire, I think we really started to work on it a bit more closely, right? So, and also linked to what Jane said earlier, right? We have enormous power of data and analytics now. So that gives me some confidence that we can further improve the insurability, including, by the way, on cyber, right? On cyber, yes, it's a difficult risk, but cyber intelligence is quite amazing what you can achieve there in terms of prevention of risks. And then this public-private partnership, I think on the one side, I would like to think that this is for the very tail end only, right? So we should not get the public-private partnership when it comes to risk funding too early in, but it should also encompass, in my opinion, the risk management aspect, right? We should create incentives for people to prevent risks. For example, where do you build your house? Does everybody need to live within 100 miles in the United States from the coast, or can we be a bit more sensible there? And then affordability, of course, is a bit linked to insurability. And there, I think what I liked a lot in your paper, which is very much in line with our own strategy, is that you move away from, simply transferring risk or paying a loss to the whole risk management process. Preventing losses, reducing losses after they happen, risk advisory, education. And I guess as we move forward, and the risk landscape changes, as you said in your paper, this can actually make risk a lot more insurable and also affordable, right? So it's also good for society, by the way, right? So we should really prevent losses, and technology, this has started 15, 20 years ago. All the property-related losses on Earth have been coming down a lot in terms of frequency already because of technology, right? So it's already happening.
Thank you very much, Thomas. Good points. Carla, Thomas mentioned climate change challenges. associated with climate change. As we know, your home country, Canada, is particularly severely affected by climate change. And you, Intech Financial Corporation, you are the #1 P&C insurer in the country. So how do you balance these emerging challenges? On the one hand, societal expectations, customer expectations towards continued affordable coverage. On the other hand, you need to preserve your financial soundness and your profitability. How do you balance this?
Mm-hmm. So I think you're right to point out that sometimes there can be a tension between affordability for customers and profitability for insurers. And at the extremes, this can even become about sheer availability of coverage at times. And so to avoid that situation, there's probably a few things as an industry that we should be mindful of. Now, the first is actually that it's important to recognize that in many cases, perhaps even most cases, the market already has commercially viable tools to solve for availability and affordability. And we need to take the lead to innovate where we can and where it's required. So an intact example that I'll draw on is that 10 years ago, we were actually spending more than $1 on claims for every $1 of premium that we were collecting. And the reason that it had become so is because of the swell in flood claims or water claims. It had actually taken over fire as the #1 cause of loss. And so, in response, we really put some focus on that file. We managed to improve segmentation. We redesigned the product so that it could be more customized per client. And in the relaunch of that product, we also, I think, educated our distribution force, our brokers, and therefore our customers about the risks that they were facing. And so in the end, not only were we able to, help the product be profitable and sustainable, but in the process of doing all of that, we also increased customer uptake of the coverage and thereby closed insurance gaps. So that's an example where I think what seems like a very challenging problem to solve, because the world is changing around us, with the tools that we have at our disposal, sometimes we can make a difference on that gap ourselves. The second thing is, building on a point that I made, is that I think it's important to educate and advocate to all stakeholders that these situations be approached with a risk-based mindset. Pricing and underwriting are just signals, really, about the size and complexity of the underlying risk that exists itself. And, some have pointed to, California as an example where constraints that were put on the pricing and underwriting of those risks without maybe enough attention at first to the underlying risk itself, ultimately caused a few stories about exits or availability. And I think, instead, when these challenging situations arise, it's really important that together across the industry, we focus on ways to help society substantively mitigate or adapt to the underlying risk itself. So anyway, that's a really important thing for all of us to focus on and put urgency on, I think. And the other thing I'll say is that I think, it is true, and this is often what gets talked about at the margins, where risks become more like certainties. Sometimes traditional insurance tools might not be suitable. And so, for example, here in Canada, according to the Canadian Task Force on Flood and Insurance Relocation, 90% of financial flood risk actually sits with the top 10% of high-risk homes. So it's very, very concentrated, even though it's a big challenge and gets talked about a lot, it's very concentrated. And this is where there can be a special role for public-private partnerships. And I'm happy to say right now in Canada, the federal government is working with industry to design a solution together that will address that particular concentration. And maybe the final point that I'll make, and that last point is a good segue, is that it is critical that we advocate for investments in adaptation as an industry, as a society. At Intact, we believe in this so strongly that we've been making investments in the Intact Center on Climate Adaptation at the University of Waterloo. But no matter what we do as an industry, society will need to evolve to deal with this higher frequency and severity. And so, one of the roles that we can play with our expertise is to shine a spotlight on the issue and advocate for investment, whether it be by government, by consumers themselves, to try and build up our resilience and our ability to well withstand some of these events.
Thank you very much, Carla. Martin, you listened to all these insurability challenges, and turning to you, because when you search the internet and you type in insurability research, etc., you immediately you quickly realize that you and your institute are really among the global leaders in terms of producing research, cyber, microinsurance. I don't know what you have covered. So what would be your advice to the global risk and insurance community based on this long record of researching insurability challenges?
Yeah, thank you, Kai, for the nice compliment. So as we have seen on one of your intro slides, it has some complexity with all the yellow and red dots on this insurability slide. So I strongly believe that the insurability challenges require a more collaborative approach from the global risk and insurance community. And with this in mind, I would see 4 points maybe. First, and as an empirical researcher, I have to say this, and also Jane mentioned it already, we really should invest in advanced risk assessment models that also incorporate these emerging and non-traditional risks. So here we can really leverage data analytics, artificial intelligence, predictive modeling, all these things to better understand and quantify these new and evolving risks. Then second, and that goes more on the insurer side, so insurers should diversify their product offerings to better accommodate those broader range of risks. So all insurance companies are now developing new policies, for example, for cyber, but they also need to adapt their existing product portfolio. If you, for example, look at motor insurance, how that has changed over the last years. Third, we should foster collaboration across industries and across sectors to gain a better understanding on these interconnected risks. One very clear and prominent example is cyber again. So we really need to bridge the barriers of our disciplines to better understand the challenges that come with cyber. But we also need to engage with other stakeholders such as governments, academia, technology experts to provide insights on these risk mitigation strategies that we can use. And finally, and that's also a point that was mentioned earlier on, I believe we should invest more in resilience and prevention measures, because any loss that can be avoided, and technology will help us a lot on that, any loss that can be avoided is from a macroeconomic point of view, economic gain, right? And certainly there are many other aspects like regulation, promotion of education and awareness. But overall, I believe we should take a more forward-thinking mindset and a more collaborative approach to navigate through these insurability challenges.
Very much, Martin. Before we move on to the final section of the debate, maybe just a quick summary, or also inviting your comments. I think we have discussed that insurability goes beyond commercial considerations, goes beyond business opportunities for insurers. It has to do with the relevance of insurance for society. I think Thomas made this point in the context of longevity, where we have seen a dramatic decrease of life insurance penetration. Maybe also on the climate front, this is long-term the biggest challenge, probably less for solvency or the financial soundness of our industry, but simply to which extent we matter to society. Thomas also mentioned cyber, 1 trillion economic losses, less than 10 billion insured claims. So do we matter? This is, I think, this is a key question that we need to discuss in the context of insurability. So let us look a bit ahead. We have explored a number of areas where we can look beyond our traditional role of taking risk on our balance sheets, and maybe starting with Carla and starting with the challenges. How do we make these shifts and these moves towards broader propositions economically viable? How about the economics of these emerging risks? How can we get a handle on that?
I appreciate the question, Kai, and I think it sort of shifts a little bit the way that we look at it, because as much as there are, it's tempting to look at this as a threat and as a challenge to be solved. Anytime the world changes, it also brings opportunities. And so anyways, the first thing that I'll say, one thing that we can do is to invest in education. It's a topic that has come up a few times from some of my fellow panelists, and we might easily see these risks as an insurance industry, but we cannot take for granted that consumers have an appreciation of the risks that they face. And I think therefore the advice and prevention services that they might need. So investing in education, both inside and outside of our organizations, will help to create the demand that should exist for prevention products and services. And of course, brokers and distributors have a very important role to play on that front. Another way that we can make the economics work, and it's something that we have started doing at Intact, is by vertically integrating in the value chain where we already see that demand emerging, and sort of helping to make sure that it grows and continues. And so a segment, for example, of the industry that is likely to grow and be more needed as a service by society is restoration services, as we hit these sort of larger catastrophes more frequently. And so investing in that portion of the insurance value chain will ensure availability of much needed services during those catastrophic events, while also acting as a source of growth for us as an industry, balancing the impact of those events against us as an insurer. And so I think those, restoration and repair moments are also really unique opportunities to then again make sure that we're opening up that conversation with customers while they're in that moment of restoration and repair, and encourage them to invest in their own resilience.
Very much, Carla. I'm turning to Thomas again. Allianz is not just a leader in insurance and asset management, but also in prevention and other risk services, I think particularly of assistance services. So based on the relatively long journey of your company in that space, which insights could you share, or even lessons could you share from establishing, building those services, and again, for making them commercially viable?
Yeah, thanks, Kai, for the question. I think, first of all, we provide prevention risk management service across many divisions, but we have one particular one, which is called Allianz Partners, but this is basically the core business. And there, I could say, really, we are not selling insurance anymore. We sell peace of mind. And this is provided via 5 platforms, which are organized around ecosystems. And when you look at the platforms, you see basically anywhere between 10 and 20 services. Half or less than half of it is actually insurance. The other one is really education, sometimes very important. Cyber, for example, a few people know enough about cyber. Yeah. Then prevention, but also after the fact, right? What can you really do? And what we recognize in households, but also for SMEs, that often the money you pay for the claim is the least relevant for the customer. So what is more relevant is that you have somebody who helps you managing the whole risk process, right? And I think that's has been a great success story over the last years. We do this, you ask for lessons learned, with a customer lab, where we have 85,000 customers constantly exchanging and discussing how to improve 30 million data points. And this allows us to frequently update the services and products, right? This is not static. This is constantly evolving. And there's also a key difference, I would say, to the classic insurance part, where you have like the motor policy has not really changed over the last 100 years. But here you have something which is constantly evolving and basically just driven by the feedback you get. Okay, what would be more helpful from a customer perspective? Let's say one cool one is really the end-to-end cyber coverage for a household, right? Very, very helpful for customers. And the smaller part is insurance. The bigger part of it is really the service aspect of it. And that's, I think, what I should say.
Thank you very much, Thomas. Jane, let us move again to life and health insurance, and let us talk a little bit about AIA Vitality, which was launched 10 years ago to promote health risk prevention through incentives for behavioral change. So based on your rich experience, where do you think will be the next frontier in terms of health risk prevention in Asia, or maybe also beyond Asia? What are your views?
I mean, the other panelists have really touched on risk mitigation already, and that's, you know, what AI Vitality does for customers. It helps them to take charge of their own health, and you know, we already see improvements in their actual health for all of the members, especially at-risk members, including things like better blood pressure, glucose levels, and cholesterol levels. So that's a good outcome, I think, for you know, for a program. We have about 1.5 million active AI Vitality members who do some 800,000 workouts every day. So they're quite active members. I think that's the first point. But it's also, but I would also stress that it's not just a sort of membership and activity based program, but it also has allowed us to deliver more than 2.5 billion in VONB from Vitality integrated products since 2018. So there's a value to doing it. It's not, I know in some of the parts at the end, it talked about, would you pay for a service? You know, so somehow integrating the service into the insurance offering, I think it is quite important. So you asked about the next frontier. And I would say the next frontier, particularly if we look at healthcare, is really about integrating it more from end to end. And we know that, you know, the more we can integrate health provision into the health insurance that we offer, the more integrated it'll be for our customers. So last year we launched a new health strategy to do exactly that, to look at our scale and our capabilities, and to really help reach from our healthcare customers, reach them with more and more services and provision. And if you look at the markets that we operate in, healthcare expenditure is expected to exceed something like $4 trillion by 2030. So a lot of that burden will fall to the individuals themselves. You said it at the beginning. Sometimes unexpected health bill is the thing that pushes people back below the poverty line. So while that can be a burden to individuals and governments, I think it's also an opportunity for the insurance industry. So I think if you look at, you know, what's the next frontier, we also have, you know, launched a health technology company, which helps us to integrate the health services with technology services at the same time. You talked about telematics at the beginning, telemedicine, things like that. So I think that's really the next frontier, is using technology and services to better equip customers to also manage their own risk, or to lower their own risk.
Thank you very much, Jane. The final question before we open it up for questions from the virtual floor. Martin, a very fundamental question, which I prefer to ask to a researcher. If we project ourselves 10 years from now, do you think it will still be necessary for people to buy insurance as we know it today, in a world where risks are increasingly becoming more predictable, more preventable? What will be the long-term value proposition of the insurance industry as we know it today?
Yeah, risk will become more predictable, but the risk of loss at the end of the day will remain, and then insurance will also be needed. And in this context, it is interesting and relevant to see that different types of solidarity exist when we look at the insurance business model. So on the one hand, we have what we call the chance solidarity. So this is just the bad luck that one here in this room is the unlucky one that has a car accident, for example. And that will remain relevant as long as the utility gain from having insurance is larger than the transaction costs of buying this insurance, right? And clearly insurance companies in a digital will need to look at the transaction cost, but that's a value which will remain. On the other hand, we have this subsidizing solidarity, which is a redistribution mechanism that in Europe we especially have in social insurance. And that might come a little more under pressure in a digital world where everything can be measured and we have pay as you live and pay as you drive, because that can lead to a de-solidarization of the insurance collective. And that's maybe a little more the critical piece in times where everything can be measured. But certainly we also need to see that the risk landscape is far from being static. So new risks will arise, and also people might change their behavior. So I believe there will remain some value. And I'm optimistic on this fundamental question whether people will still need insurance. And I also believe that it will create a lot of opportunities also for insurance companies, and it create a lot of economic wealth.
Thank you very much, Martin. So I'm pleased to share a few questions from the floor with our panelists. We received a number of them, actually almost 25. Let me start with a question for Jane on the use of AI and in the context of better risk selection in your markets. The question here is, how do you manage the regulatory pressures or constraints associated with this usage of AI?
Yeah, so let me start by talking about kind of old-fashioned AI, not generative AI, because I think generative AI is the new kid on the block. But sort of the old-fashioned AI, or machine learning, has been around, for many, many years. I think these things always come back to having the right framework in place, because that's how you determine whether you have the right protocols, whether you're doing the right thing. And so I think that if I look at how do we manage AI or these kind of new technologies, it's about having a risk framework that really looks at how is the model trained, how is it updated, who decides, all those kind of key criteria, and having the right governance around it. With all of these things, I think that's the way we manage them, is by good governance and by strong frameworks, and then executing within them. Because at the end of the day, I mean, these are sort of approaches and models that have been around for a while. It's just that the computing power is much stronger now. So ensuring that we understand how the model works is just as important with an AI model as it was with the old kind of macro model in our old world of Microsoft and other tools. So for me, it's really about the framework and the governance that you have around it.
Thank you, Jane. Is there anything other panelists would like to add based on your experience? Or maybe also looking beyond risk selection, how about claims, for example? AI in claims, is that something where you see an impact already?
Yeah, I think AI in claims, I think, is one of the most obvious applications, right? So it allows us in some of our businesses to pay, 95% of claims immediately. That, of course, is good customer service, even though it's almost too good, because, I mean, if it's too quick, the customer doesn't really realize that you have done something for him, right? But that's one of the most obvious ones, for sure, right? But also pricing, getting ahead of fast-changing trends in pricing is also very, very important. So, and with Jane, right? I mean, talking about AI mainly, right? Gen AI is early days, and other than that, that's very, very important technology for sure.
Thank you, Thomas. Another question: protection gaps, as we discussed earlier. The question is, those protection gaps indicate or are a sign of unmet market demand. What stops the insurance industry from meeting that demand? It's a huge opportunity for insurers to increase penetration levels. So what are the roadblocks? Simple question, but important. Who volunteers?
Maybe if I can begin.
Thank you, Martin.
So one example for this protection gap is the one on cyber risk, right? We mentioned the numbers. So small the insurance market, so large the economic cost of those cyber risks. And so that would be a very natural way to go inside that market. But I see limitations both on the supply and the demand side of that market, right? If you look at the supply, all insurance companies are now doing their experiments, starting writing policies to get experience with this new type of risk. But I do also feel at the same time that they are reluctant to go deeper into the market because they anticipate that there could be some issues like the accumulation risk and the heavy tails and asymmetric information more pronounced than with other types of more standard risks. And so the supply side has some limitations, which is the reason why cover limits are so small and do not really meet the need of the people, right? If you look at the demand side, what people want, they want protection for business interruption. 1 week, everything is done. But that's not what insurance companies provide. So that would be one example where we see, okay, there's a huge protection gap, but there are also reasons for that. And certainly we all hope that this will change in the next 5 to 10 years, but it takes some time.
And unfortunately, when we look at the data, these protection gaps in many areas, they keep growing. It's not about shrinking, they keep growing, which is a particularly worrisome feature, I think. Is there anything Thomas, Carla, or Jane would like to add on that?
I would just like to say, I think that Martin's answer was a great one. I think he's right that there are gaps both on the supply and the demand side. And I think some of the gaps that exist, perhaps not all, but some of them are challenging to tackle because there is so much uncertainty associated with them that it is very difficult to craft what would feel like a sustainable and responsible solution, albeit I will say I do see our industry making great attempts at that, because it is true that, you know, our industry is about risk. And so when risk is growing, it is a tremendous opportunity. It is for us to figure out how to navigate that and build responsible products that can, you know, help wherever we have opportunities.
I would also make a difference between liability, cyber liability, and cyber first party, right? Cyber liability a lot better insurable for sure. And there, I would also say I see a small analogy to nat cat risk. And why is that? Because I mean, these are all modeled risks, right? We do not have enough experience data on the tail end of nat cat. What do we know about the next big hurricane, the next earthquake? Not much, right? And so what happens in these lines of business is simply you have a model which is as good as it gets, and every now and then you see that the model was not great enough and you improve, and then you adjust the price and you sort of ex post regain the profit in a way, right? So this, I would say this is just normal way of doing business in model-based lines of business.
And it's also interesting to compare, if I may shortly add that, with the situation we had with operational risk like 30 years ago, right? Where we also had only little data, not a lot of experience. Everybody was looking a little, maybe it's just the same development and we just need to wait and continue doing research.
Exactly. And also look at what I also look at is the total annual aggregate losses, because of course you have here and there spikes, but the volatility of the total aggregate losses, nat cat and cyber, is not very different. So if you feel comfortable with nat cat, why not with cyber, right? Yeah, you need to simply do more work on it, get more comfortable. But I'm quite confident that we will get to, I don't know, 20, 30 billion of premium over the next decade, maybe. Yeah.
It's still a drop in the ocean compared to the economic losses, right? Anyway, so maybe a follow-up question here, also reflecting something I received from the audience. Insurance-linked security, just tapping into capital markets for risk capacity. We have seen a few small steps on cyber front. Nat cat is much more established. Do you think that at some stage tapping into capital markets could make a difference in addressing some of these protection gap or insurability challenges?
I guess I can say a brief comment, and I'll just say that I think the answer is yes. As an industry, you know, capital providers play an extremely important role in helping us to provide the products that are needed to meet the risks of society. And I think it's true. There is lots of, you know, innovation, if we could call it that, and that word's been used a few times, coming up in different types of mechanisms that go beyond sort of traditional reinsurance, for example, that can sort of help to capitalize the industry and make products possible. And I think to the degree that the risk envelope continues to evolve, that capital will be very helpful, and those creative solutions can be very helpful in encouraging innovation on the product side.
I would also say this this helps with one of the problems, Kai, you are showing your paper, the systemic risk, right? So we have a lack of diversification, but if we can carve out certain part of the risk and give it to an investor where there is a great diversification, then of course you create value, right? I mean, we have seen this with NatCat, we have seen it with cyber now. So I would say, yeah, there's a great case to be made to separate the risk management from the risk capital provider, right? So that should continue.
And certainly that will work very well, if I may shortly say, for risks that are uncorrelated with the general economy, which might be the case in most circumstances for cyber. But also here, investors somehow anticipate that there could be these extreme scenarios. And same for pandemic risk, right? Also for pandemic risk, it would be very interesting to look what capital markets could help us. But investors anticipate that you have this correlation, and then, of course, it's limited. But I agree that for many of these dimensions, it could be a very interesting discussion.
And Martin mentioned pandemic risk. Let's talk about the non-business interruption manifestations of pandemic risk. Do you think that capital markets at some stage could also play a meaningful role in terms of mortality, morbidity, longevity? What is your vision for that? Will it start to make a difference at some stage?
I think there have been a number of experiments over the years, right, to attempt this. And so, you know, I'm sure it will happen. It's just a question of, you know, what are the ingredients that are needed? And, you know, if I look at what we talked about with things like NatCat, you know, we know some of the main ingredients are, first of all, the ability to understand and model that risk, and to agree on an index, and to agree on a trigger, right, parametric trigger, so to speak. And so the question is, how do you devise those same things for some of these other areas, potentially life and health? So there's no doubt to me that, you know, there's some solution out there, but I think the industry has not quite found it yet, not perfectly, and probably it has a bit to do with not at scale. Let's put it that way. The industry hasn't found the solution at scale like it has with NatCat, and so maybe part of the question is around how do you quantify the risk in an unbiased way that everyone can accept the index that you need to use, for example.
So maybe Jane, if you allow me to ask a follow-up question, because it's addressed to you, climate change, life and health exposures, climate change. I know that this topic is close to your heart. So the question is, what kind of resilience can life insurers, life and health insurers introduce facing the potential increase of diseases due to climate change?
I think, I mean, first of all, for life and health insurers, I think that there's a tremendous amount that we can do on the asset side of the balance sheet. And that's where a lot of our strength is, right? In terms of looking at ESG and how we support things going forward. So that's part of it. But I think when I look at the other side, and Kai's asking me because he knows my view on this, I really believe that we need to collectively throughout our industry find ways to model, for example, the impact of climate change on disease burdens, because we don't know the answer, and maybe someone does, but I think collectively as the industry we don't know the answer to that yet, and that's probably something that has to happen in a collaboration with outside the insurance industry. We need to work with experts in this field to really understand it and to have some collective models, because there's no doubt, Kai, that there is some impact there, but we need to, you know, sort of have some collective modeling to understand it a bit better.
The Geneva Association will publish its first paper on the subject matter in February next year. But I can tell you it will raise more questions than it will provide answers, which is, I think, the natural thing to expect at this stage of the debate. Now,
at this early stage, yeah, that's what we should expect.
Exactly. Another question, which I think can be taken up in principle by all of you. The question is, can consultation, prevention, restoration services potentially become a major source of income for insurance companies in the future rather than premiums? What are your thoughts? Currently, we are far from that, but going forward?
Yeah, I mean, I'll make the comment. I think certainly it should be seen as an opportunity for our industry because we have, so much information, so much expertise already around, what is happening, that to be able to, share that information and advocate for the growth in services that would sort of help around the events themselves. Certainly as Intact, we've observed that and have started to make investments in that direction. I've already spoken about restoration being a very important part of the value chain that, is adjacent to, but, separate and apart from the core insurance product. So, I guess I would say as well, I'm a bit hopeful because to the extent that we're able to build demand for things like, prevention services and adaptation and resilience investments post-event, I think it has the potential to, legitimately improve the experience of society around those events themselves.
Also agree that from an economic and societal point of view, we should really hope that it has the potential to become the bigger source of income, right? From a customer point of view, and if we look at risk management in a more holistic way, it would be very good if we could move in that direction and make prevention a bigger part of our income. And certainly some players in the market will go in that direction and be successful, and those should then serve as role models for others, because it's clear only doing the traditional insurance models for many reasons will come to its natural end at some day.
Very good. I think we have time for at least one more question, an interesting one here. ESG risk. What do you think will be the impact of ESG risks in this changing risk landscape? Very interesting question. Who would like to take a stab at this one?
I can take a first answer from an academic perspective, because it's a topic which is not very well researched, so we do not know a lot about it. There are a few first empirical studies that look into this, both from a client as well as from a shareholder perspective, and there are some indications that even clearly clients, customers, if you ask them, everybody will say, we want this. The question is then, are they also willing to pay? And there are first studies that show, yes, they are also willing to pay a little more for being more on the green or more general on the ESG side. And interestingly, recently a paper was published by Nadine Gatzert and co-author that looks at it from an investor point of view. And they found empirically that as also investors see the value of being ESG compliant for insurance companies, meaning being rewarded by higher firm value. And that for me is an interesting and important signal that it's not only the clients, but also the shareholders that see this as a future and value generating investment being more in that direction.
Anything to add on this question? It doesn't seem to be the case. So unfortunately, we need to conclude. We was unable to address all the questions that we received from the virtual. Thank you very much for this. May I now invite, before we adjourn, may I invite our speakers to summarize in 1 minute each, please, the key takeaways that you would like our audience to remember. Maybe I would like, can I invite Carla to go first?
Yeah, sure. So maybe I'll start by saying just one of the reasons I chose insurance as my career is because our core purpose resonated so strongly with me. I mean, when you break it down, really, we are in the business of helping people in moments of great need. But at the same time, we are running businesses. And when we think through a business lens, as I've said before, risk is our business. And so I think the fact that risk is growing and evolving should be viewed as a great opportunity for us. Of course, the challenge is to navigate that transition, finding those opportunities that are really at the intersection of helping and winning and putting the full force of our efforts behind making those intersections become viable realities. And for those situations, we've talked about some of them, where winning seems elusive, but help is still needed. We can still be very credible advocates, bringing other parties to the table and volunteering our expertise to help navigate solutions that include more parties than just ourselves.
Jane, please.
I guess I'm still very captured by the statistics at the end of the report from the consumers, and so maybe that's what I would end with, is that whenever we're doing anything as an industry or within our companies, we have to always ask ourselves, what does the customer think? What is the consumer thinking? How can we help change the perception versus the reality? Because, like I said at the beginning, I read some of the things at the end and I thought, but that's not how we see the industry. So clearly, we have some work to do in changing the perceptions. And so I guess those would be my parting comments. Let's always make sure we're thinking about how this is landing in the eyes of the consumer.
Did you ask me, Kai?
Yes. Yes.
I didn't hear you, sorry.
No problem.
No, I think, it's exciting times in a way, right? Because as Carla was saying, right, if risk is changing rapidly, this makes it all the more interesting to work in the insurance industry. I think, as I mentioned before, we can get more up to speed, be quicker with innovation when it comes to understanding risk better, right? So I think overall, in the past, we have done a good job, but I think the quicker dynamics that you outlined in the paper require simply higher speed on the side of the insurance sector. And I also strongly believe in the opportunity, I should say, right, to expand from pure risk transfer to this prevention services, to this post-close loss reduction services, because overall, this also fits very nicely with this sustainability thinking, right? Preventing losses, reducing losses after losses happen. Of course, this is all about making things more sustainable, right? And at the same time, more affordable. So a lot to go for in this part. And I would say very much underdeveloped with few exceptions.
Thank you, Thomas. Martin?
So I agree, exciting times for our industry and also for the society as a whole. We have seen and discussed the dynamic shifts of the global risk landscape. We have seen and discussed the consequences for insurability. So my hope is that everybody really recognizes the importance of staying ahead of these changes, leveraging innovation, develop collaborative strategies to navigate through this future, where risks are more predictable, more preventable. And of course, I know that this now seems odd if I, as an academic, end here with a consulting firm, but I think the McKinsey study very much brought it down to the ground when saying we should come from detect and repair to predict and prevent. So that's really the shift that I expect to see in the insurance business model in the next, say, 5 to 7 years.
Thank you very much, Martin. I think we end on a very positive note. It's definitely not doom and gloom. I think we are all convinced that the insurance industry will remain relevant to society. We need to harness the innovation power. We need to harness, maybe also new forms of capital. But I found it also very important what Jane said. We should always keep track of what the customers think. Otherwise, we may run the risk of disconnects between us and the marketplace. So with that, let me thank all the speakers for sharing their insights with us today. This is very much appreciated. Carla got up very early. Jane probably sacrificed a good dinner for us. So this is highly appreciated. I would also like to thank the many participants who have also submitted questions. And again, apologies for not being able to accommodate all of them. So thank you again, and I wish all of you a happy festive season. But before you switch off, please let me remind you to kindly provide your feedback. In our short pop-up survey, we obviously very much like positive feedback, but it's even more important probably to learn where you see further room for improvement so that we can continuously increase the quality and relevance of these webinars. Thank you very much and goodbye.